business owners likely will have only one shot to sell a business. Most don't understand what drives value and how buyers look at a business. Until now. Welcome to the How to Sell a Business podcast, where every week we talk to the subject matter experts, advisors, and those around the deal table about how to sell at maximum value. Every business will go to sell one day. It's only a matter of when. We're glad you're here. The podcast starts now.
Have you ever wanted to know, how a restaurant is valued or how they're sold? You see them all over. I mean, they're everywhere. There is a restaurant in nearly every corner in every strip center, everywhere. And each of those businesses, have a family behind them. And that family is dependent upon not only the earnings ability of that particular business, but also when it goes to sell or when they go to sell. And so today I'm excited to have Steve Weinbaum of We Sell Restaurants. He is out of Atlanta, and their shop is called WeSellRestaurants.com. And they go across country and represent various businesses, whether it be, owner operated, absentee owned, franchises, independents. And so on this episode, we dive deep on what makes these types of businesses valuable and how you sell them. So I hope you enjoy my conversation with Steve Weinbaum. I'm your host, Ed Mysogland. On this podcast, I interview buyers, sellers, deal makers, and other professional advisors on what creates value in a business and then how those businesses can effectively be sold at a premium value. So on today's show, I'm so excited to welcome Steve Weinbaum of We Sell Restaurants. One of the things that has always been a challenge in selling businesses, especially in the food business, is just the level of complexity that people so underestimate how to operate it. And so I'm really excited to have Steve on to talk about, how businesses actually get sold, because it's truly, when you think about, how many of those types of businesses are out there, those are families that need to be able to sell those businesses. And we're certainly excited to have Steve on to visit about, how you can make that type of business saleable. So Steve, welcome to the show.
Thanks. Appreciate it. Thanks for inviting me, Ed.
So before you came on, I was doing a little bit of an intro, but I thought maybe you could give me a little bit more of a, kind of a high level overview of you and We Sell Restaurants.
Sure. So my background is believe it or not, retail marketing. Worked for Macy's for close to 25 years. And a lot of my responsibility is more on the finance side, the planning and whatnot. So certainly in selling a business, as you alluded to, a lot of it's numbers. So I've got a strong numbers background. I also have a marketing and sales background. And then when I left retail, I went into the payments industry. You mentioned gift cards to me earlier before we started the show. And I worked for a gift card company. And some of the most popular gift cards are franchise food gift cards, the Red Lobsters of the world, the Dunkin' Donuts of the world. So I kind of got to learn the franchise world then. And then eventually I kind of moved into selling restaurants about 7.5 years ago. I've known actually the owners, Robin and Eric of We Sell Restaurants, before the company even started. We worked together at Macy's and stayed together. And that's how I joined the company. A little bit about We Sell Restaurants, which a lot of people don't know. So we're the only restaurant brokerage company that has a national footprint. You have a lot of local brokers, business brokers that specialize in a category, or you have big national brokers like Transworld or Sunbelt. We're unique in that we're national, but we only deal in restaurants, bars, pubs, cafes, and things like that. And again, like I said, we are a franchise. So we have brokers and offices in many cities around the country, in Charlotte, in Denver, in Minneapolis. I'm a corporate broker. So anywhere we list a restaurant or have a restaurant that needs to be sold that's not in one of those markets, I take that listing. So I've sold them from Texas to Chicago to Atlanta to Michigan.
Nice. So I guess I want to start with, we're in this new post-COVID world. So where is the deal-making industry for food and beverage?
It's interesting because, there were a lot of residual effects of COVID. And coming out of COVID, there were a lot less restaurants because some couldn't survive the pandemic, even though there was a fair amount of government assistance. But the ones that did survive came out a lot leaner and meaner, so to speak. Certainly the proliferation of third-party delivery, Uber Eats, Grubhub, DoorDash. Prior to COVID, I used to see that representing somewhere between 5 and 15% of a restaurant's sales. Post-COVID, I can see it representing a third of their sales in some instances, especially it depends on the cuisine. Some cuisines travel very well. Italian travels well. Subs travel well. So those businesses actually got better coming out of COVID, where those restaurants that relied a lot on social gathering, had big footprints, was more of an experiential type of dining event. Those are the ones that suffered. But, to answer your question, 2021 was a record year for We Sell Restaurants ahead of 2019 and pre-COVID. Then 22 is off the charts. We were up about 40% in restaurant units sold. And again, for a myriad of reasons.
So, yeah, and it's funny you say that because I told you that I had been reading the most recent Biz Buy Sell Insights report, and Robin, your co-founder was she contributed that article saying that restaurant sales across the board were up 20%. So I guess the question is why restaurants are up of all the businesses. Why would I guess I theorized that, okay, I COVID stress tested my business. I got leaner. I added a different profit center with delivery, and now I want to sell it. That's only a theory, but there's got to be more than that. Well, don't you think?
Yeah. So we have different categories of buyers. Right. You always have the owner operator that's worked their whole life in the industry. They've been a chef, a manager. They've saved their nickels and dimes, and now they want to work for themselves. And that's always been a strong member of the buying pool, as are the investors, the ones who want to buy multi-units. They don't want to be owner operators. They want enough EBITDA where they can be absentee or semi-absentee owners. But COVID, I know the job market now is very solid, but there were tons of layoffs during COVID, and a lot of them were corporate jobs, people making six figures. And the beautiful thing about selling a restaurant is, as long as you have the verifiable earnings and books and records, which I think maybe we'll talk a little bit more about later, you can get a six-figure earnings owning a restaurant with as little cost of entry as 2 times earnings. If you think about it, restaurants are constantly turning their inventory. So if you buy a liquor store, or you buy, a retail store or something else that sells product, you also have to invest tens of thousands of dollars in inventory. Not so with a restaurant. Restaurants typically sell between a 2 and 3 multiple. So as I said, if you have to protect $100,000 a year income because you are in some corporate, middle management job, you can buy a restaurant for $200,000, have some operating capital, and replace those earnings fairly quickly, as long as, again, you work with an experienced business broker like you or I who knows how to validate the numbers and do the valuation. But I think that's one of the reasons sales are up. Maybe some pent up demand because no one was buying restaurants in the first half of 2020. So there may have been some pent up demand. But again, if that article, total business sales were flat to down compared to restaurants being up 20, which is a huge gap, which just shows the resiliency and desirability of the industry.
Well, you had alluded to staffing, and I know, I mean, it seems, at least in the markets we serve, it seems that staffing is so difficult. In fact, we were, so my daughter, wait 1 second here. Oh, I had a little issue but I fixed that. Okay. Mm-hmm. So we're back to the question. So I had, we've been seeing that staffing is difficult. So my daughter, when she comes home from college, she is in, one of the higher end restaurants here in town. And I know they have had a terrible time keeping people. And maybe it's just the market, but boy, it seems as though every restaurant that we go to, including the one, we're recording, the day after Valentine's Day, those, we had a rough experience last night, my wife and I, just due to, shortage of help. And this is a fairly high end restaurant. So, is it different in other markets that staffing isn't the challenge?
No, it's pretty consistent across the country. And,
okay.
What the phenomenon is, I don't know if it's just a change in attitude towards working, or, it is also one of the reasons some people are selling, because they're tired of having to deal with the staffing shortages. Okay. I remember I had a pub listed pre-COVID, and it was listed for $250,000 based on a little over $100,000 a year in earnings. Mm-hmm. And then we took it off the market, and then we put it back on the market post-COVID. And I looked at the financials, and the volume was there, but the earnings were down. And the earnings were down because that dishwasher that was $9.50 an hour is $13.50 an hour. So people are demanding higher salaries. There's definitely still an issue. As we talked about, post-COVID, more delivery, more carry out. Right. It's definitely an issue in the industry. And if you take that and layer on top of that the supply chain issues, the cost of a case of chicken going double in price. If you're a restaurant owner, you've got to be numbers savvy, because restaurants, people always hear that your cost of goods should be less than 1/3 of what you sell. So if you do $750,000 a year in sales, your cost of goods should be $250 or less. But even with that number, restaurants work on a very slim margin. So if your cost of goods goes up 5 points and your labor goes up 5 or 10 points, and you don't adjust prices accordingly, all your profits are gone. So, it's good to pay people what they deserve, but you also then have to build that into your business model.
Well, I'll tell you, as we were talking before we started, we were down visiting Clemson, and we were at Chick-fil-A, and they were hiring at $28 an hour. $28.
Now, I haven't seen that, but that's remarkable.
It was, and it's like, clearly they're not going to have a staffing issue. And we were just, totally dumbfounded. We're seeing $17, $18 an hour here in the Midwest, but boy, oh boy, like I said, and I think the important part that you said is that it's one thing to pay them. It's another thing not to adjust your prices to reflect, to keep those margins. My next question has to do with independent restaurants. Mm-hmm. I love independent restaurants. I think there's a personality that you can't, I don't want to say you can't get with a franchise, but often you can't, and it's a mom and pop and probably a family, there's family members in there, and I enjoy that. But part of it is that whole concept of personal goodwill, that, if Steve isn't there anymore, I don't want to come, because I've been seeing Steve there for 20 years. So Are independent restaurants difficult to sell?
So,
and how do I make them more saleable?
So sometimes, the answer is sometimes. Contrasting them or comparing them to franchises provide a comfort level because you've got that corporate support, the corporate marketing, someone to call, if your point of sale system goes down or you're having issues. There are other franchisees in the market you can call on, to ask questions and help. They help you with supply chain and those other things. So there is a comfort level with franchises that inherently make them a little bit more sellable or easy to sell. Sure. But you're also paying for that comfort. I mean, 8% royalties and marketing fee is not uncommon with a franchise. Right. And when you're in an industry where you're lucky if you're making 15% on your sales, that's a big bite. So so there are certainly advantages to owning and selling a franchise, but again, there are also some challenges financially because of the royalty that you're paying. Now, shifting to independence, I said sometimes because it is the number one thing that you need when you're selling a restaurant is good books and records. You need to be able to verify and validate your sales and then also your earnings. So, a point of sale system that you can run reports on to show what your true sales are, sales tax filings that then match your point of sale report, and then a P&L that ties back to all of those things is critical if you're a independent restaurant owner to have good books and records, and then obviously keep up with all your expenses. That doesn't mean if you can legitimately put your life insurance or health insurance or auto or cell phone through the business, look, those are all things that business owners do every day. But as long as it's verifiable, then that doesn't count against you when you're doing the business valuation. What makes an so that's the number one most important thing. Number two is longevity, especially when you're trying to get lending. You want to have at least 3 years under your belt and at least 2 or 3 years of tax returns. Again, that you can validate to help sell your restaurant. So good books and records, at least three years in the business. And then, believe it or not, I get this question a lot. My lease is about to expire. I want to sell my restaurant. What should I do? Good leases help sell restaurants. So if you have a restaurant and you have a good long-term lease at a good rate, there's a good percent of sales, extend that as long as you can if you're looking to sell, because that just takes one element out of the sales process. So with those things in mind, independents will sell as well or better than a franchise because they can be more profitable.
And more flexible.
One
of the things that you brought up is the lease. And I'll tell you that, I don't, it's not necessarily, I don't want to say I disagree with you, but I from the standpoint of, every landlord locks you down with that personal guarantee, and it's like, all right, if my lease is expiring, I don't know if I want to go on the hook for another 3 or 5 years so I can sell the business. But conversely, and again, I acknowledge I'm talking out of both sides of my mouth, but, conversely, it's, our advice to every business owner, regardless of the type of business, is to operate your business as if we're going to be unsuccessful. Mm-hmm. So what would you do?
Well, let me just address that for 1 second, because we could do a whole segment just on leases.
Right.
Or landlords. Some are great and some are not so great. We'll leave it there. No offense to any landlords listening.
Amen to that.
But, you bring up a good point, that personal guarantee. And not to go off track, but I would say 90% of the sellers I work with, when it comes time to talk about the lease, and they see the lease assignment and they see that verbiage, that none of this releases the seller from their liability. And sometimes even through continued options to extend, you're right. If you know you're going to sell your business and you want, and again, you have a great lease, you want to extend it and not give the landlord the chance to leverage that sale transaction, negotiate out the personal guarantee. I mean, look, everything in life is negotiable, and we work with some very strong real estate attorneys if necessary, but you can You can limit your exposure to 1 year on a personal guarantee. It doesn't have to be the whole length of the lease. You can have it phase out after X number of on-time payments. Or if you've been with that landlord 5 or 10 years and you want to renew, you say, look, you know me. Let's just eliminate the personal guarantee at this point, and I'll be happy to renew for another 5 or 10 years. So there are certainly a lot of techniques and approaches to take with the lender. You won't always be successful, but again, if you don't ask, you don't get.
Yeah, well, those mid-term leases, where there's a few years left, and there's that personal guarantee, and boy, it's like, man, I may have to take some seller financing, and I'm stuck if this guy or this woman can't operate this business. So I recognize that risk, but boy, oh boy. Okay, so we had earlier we started talking a little bit about financial metrics, and I know you said about a third goes to cost of goods. So occupancy, since we're on rent, where does that fall? So
for a restaurant, you want to keep your occupancy or gross rent, not just your net rent, but CAMs,
sure,
property tax, property insurance, your gross rent, what you're paying out each month, including your your additional rent. You want to keep it no more than 10%. So if your restaurant is doing, $500,000 a year, that's $4,000, that's $40,000 a month. You want to have a total rent that's $4,000 or less. I would say the number one reason I see restaurants underwater, meaning they're not selling.
Sure.
They're not selling because of the money they're making. They're selling because they're working and making no money, is because they're working for the landlord, because their rent is 16, 17, 20% or more of their monthly sales. And when you're already working from that disadvantage, it's very hard to turn a profit.
So is that a matter of renegotiating your lease, or is it, you got a crappy business and there's nothing we can do?
Well, so you're doing a commercial for We Sell Restaurants. So
that's what I'm about.
The owners of our company put out a book. It's called Appetite for Acquisition. It's available on Amazon. That was not a plug, but there's an entire chapter about resells versus building from scratch, especially as it relates to franchises.
Sure.
So, my advice is, if you're buying an existing business, which is what we're talking about, look at the P&L, look at the sales they're doing, look at a 2 or 3 year history, look at the rent. If the rent is consistently 10% or less, then you're in a good place.
Yeah.
If you're starting a new business, whether it's a new franchise, or let's say you're buying an asset. So we haven't talked about asset sales, but a lot of times people sell restaurants that are not profitable. They just want to get out. Someone sees a beautiful build out that would cost them $250,000. They can get into the space for half that money, but they're not going to keep it a sandwich shop. They're going to make it a pizza joint. Then make sure you have a realistic sales plan. Don't sign off on a $9,000 a month rent in a 3,000 square foot location in the metropolitan area if you only think you're going to do $600,000 a year. You're never going to make any money. So if you're buying an existing restaurant, it's easy. Look at the sales, look at the rent. Mm-hmm. If you're going to open up a new business, have a realistic sales plan, and then look to see what the rent is, and it makes sense. I mean, can you go back to a landlord and negotiate? Maybe. But if it depends on demand, if they think they can lease that space for that rate and put a paint store in there, then that's what they're going to do.
I'll tell you what, I've known a lot of landlords, and there's not a whole lot of motivation. If I got a lease with a personal guarantee, that I don't have a lot of motivation to do anything. But,
no one wants a lawsuit to have to go after the money. And the interesting thing about landlords is, most of them are more concerned with the valuation of the property than the income that they're generating. So if the building is valued at $30 a square foot, they would rather sometimes leave a space open for a few months at $30 a square foot than lease it at $20 a square foot, because then that devalues the real estate. So, most Most tenants don't kind of understand that dynamic, but that's why landlords don't like to go down on rent. They'd rather give you TI money.
No.
They'd rather give you TI money and raise the rent.
Totally understand. I mean, I don't disagree with that. I'm just saying that the reluctance is, there's not a whole lot of motivation.
Well, and coming out of COVID real quick, you had landlords that did nothing for the tenants. Mm-hmm. You had landlords that, and some of the tenants didn't even understand it. They abated their rent, which was the most generous thing. They actually said, you don't have to, you can only pay me 10% of your sales for these months because I know you're struggling. And then other landlords deferred it, right? Where they said, you can pay me less now, but you're going to have to pay me later, which was just moving the nut forward. But you're right. Yeah. Landlords don't have a lot. Some are great. I've probably worked with 200 landlords in my career. Some are great. Some are not. But at the end of the day, they're worried about the value of their property and collecting their money.
100%. No. And again, I mean, they have a business too. I'm not. No.
Absolutely.
Yeah. All right. So continuing down our income statement. Mm-hmm. So our payroll, what's our labor cost? What's a good labor cost to make it saleable?
So let's say we're at 30 to 35% cost of goods. Yep. And cost of goods could include restaurant supplies like paper. People do accounting is done differently. So say 30 to 35%. Labor, if you're an owner operator, you own a small Italian restaurant or a sandwich shop, and you're there 40, 50, 60 hours a week, running the place, then honestly, you want to get your labor as close to 20% of sales as possible. If you're an absentee or semi-absentee, so now you've got a general manager making a premium salary, who's also, who's kind of taking the place of the owner, ideally you want to be at 25%. Those numbers, especially in this environment, are harder to hit. So, maybe those numbers are now up to 30%, but the most successful restaurants. And the other thing you think about is if you own, let's call it a sports bar.
Yep.
Your servers don't even have to make minimum because they're making tips. So you can pay them, I don't know, 2.7, whatever that number is. Mm-hmm. Same thing with your bartenders because they're making a lot of money on tips. So most of your salary is in your management and then in your back of house. So you got to just kind of watch your back of house expense. If you're serving $40 dishes, $30 dishes, steaks and seafood, you can afford an $80,000 chef. If you're serving, chicken wings and hush puppies, you've got to manage your back of house staff. But I would say 20 to 25% is the ideal range.
So, and then lastly, you've said it a couple times that, your pre-tax profit should be between, roughly between 5 and 15%.
Yeah, that's typically what I see. There are certainly exceptions. All right. I mean, look, I've seen, I've got a deal in contract now. It's a Latin American restaurant in New Jersey, and they are in 2,400 square feet, and I think 1,800 square feet of it is kitchen. They have no sit down. They do 7 figures, and their rent's like $4,000 a month. So their rent is like less than 4% in net sales. That additional 5 or 6 points that rolls right through to the bottom line. So they're running like a 22% EBITDA. So it's, each business has its own character to it. But if you're a restaurant owner, understanding, you want cost of goods under 35, labor under 25, and rent under 10. Then when you add in, which I think is where this conversation is going, your utilities, your credit card fees, your licensing, your repairs and maintenance, all the other, trash removal, all those other things aside, let's say they're under the 15 or 20% of sales, you should then be left with, again, around 10% for yourself. 5 to 15, I would say is kind of more of a range.
Yeah. All right. I wanted to move into structures. And the first thing is, the first thing I wanted to talk about is the difference between a lifestyle type restaurant where, it's an owner operator and they're sleep eating and breathing it. And conversely, I want to talk about, I don't want to say an actual business, but because that's not how I mean it to come across. But like I was telling you that my daughter, she works for a company and it is a machine here. I mean, multiple locations, operates, there's different levels of management. It is a truly a machine. And so my question is, I know that the buyer pool is higher for the first one. So the lifestyle ones, because there's more, it's easier to buy. Conversely, the larger operations, I think it's more difficult, just only because it's harder to bring the secret sauce that makes that business special, if that makes sense.
Yeah.
So anyway, what say you?
It varies. So the toughest restaurant to sell and value is one where it's a chef operator for the reasons you gave, right?
Yeah.
Because at that point, when he leaves, the quality of food, which is what most people are going for, leaves. Now, if you have a large operation, and again, I've literally sold restaurants from $40,000 where it's just a seller wanting to get out, up to $2 million, whether it's a single store or multi-unit. And if the owner is more the operator, the scheduling, the hiring, the financials, then it's an easier sale, because a great chef is a lot harder to come by, especially mirroring that cuisine, than someone who just is efficient operationally. So as far as it being lifestyle, and again, in any business, brokerage business, you got to understand the makeup of the business you're selling. Is it owner operated? Is absentee owner owned? Is there a GM in place? And what is the owner's role? Because the buyer, like I said, they're buying a business, they're buying an income, but they're also buying a lifestyle. And if that individual is strong operationally but horrible in the kitchen, then you're not going to recommend a restaurant that is chef driven. And on the contrary, if they're a chef and they want to buy their own place, then finding a place that's chef driven is actually appealing to them. So it really, it's I always tell my clients when they ask how long is it going to take to sell a restaurant, all these other things, I say this is like a marriage. It's just finding the right buyer and the right seller at the right time, and that could take days, weeks, months, or sometimes even years. And again, for all the reasons you just brought up, you just want to make sure that it's a good fit, and that the skill set of the buyer and the infrastructure that the seller is leaving behind will mesh. So when you're moving into deals, I mean, and keeping all of that in mind, what are the structures you're seeing? How, everybody fails to understand that, it's one thing about buying a job, but this is an investment like anything else. So I'm trying to mitigate my risk in making this kind of investment. So what are the structures you're seeing? Who's financing? Is there any rough structures that you can share? Well, there's basically 4 different ways to finance a restaurant. There's cash, which is king. Amen. There's seller financing, where the buyer brings some dollar amount to the table and the seller holds a note for the rest. There's SBA lending, which is, I think, a lot of what buyers feel they can get. And then there's some unsecured lending approaches where they're lending based on other factors of the buyer, not necessarily the performance of the business. The thing that everyone looking to buy or sell a restaurant has to keep in mind, especially the buyers, is that the buyer with an SBA loan, the buyer needs to collateralize the loan. And what I mean by that is, when you buy a house, they do an appraisal on the house. They'll lend you up to a certain percent of the value of the house. If you don't pay your mortgage, they're going to take your house. You don't have that when you're selling your restaurant, because the value of the restaurant, as we talked about, is in the earnings. It's in the sales. it's not in the value of some used equipment that may be worth $50,000 or $100,000. So when you're doing an SBA loan, the SBA or the bank is going to want the buyer to take a second mortgage on your house, possibly become a beneficiary of your real estate. It's very requiring, which, look, it adds to the risk if you're doing an SBA loan, but sometimes that is by far the best route to go. Now, the deals that best qualify for SBA loans, to answer your question, larger price deals. Most SBA lenders want to see something at least above $250,000 price point, and at least two or 3 years of tax returns. And they want to make sure that the debt service is there. So when someone's buying a restaurant, the SBA is going to say, okay, here's the verifiable seller discretionary earnings. Here's what the note's going to look like. Here's what the buyer needs to live on. If the restaurant's making $10,000 a month and the buyer says they need $5,000 and the SBA note is going to be $3,000, that's fairly easy math because they have enough to cover the note and the lifestyle. So well-established restaurants, good books and records, profitable, at least 3 years of books and records. Over 250, I'd say, is a basic threshold. You're good to go with SBA if that's the direction you want to go. And you can get SBA, loans for 20% or less of the purchase price. So, you can buy a $200,000 restaurant with $40,000 down, plus, closing costs and some operating capital. If SBA isn't the way to go and you don't have the cash, then seller financing is certainly an option. That's where the seller will carry a note for a certain amount for a period of time. We do a fair amount of those. But people that sell restaurants, they're not banks. So, typically there, you want the buyer to come to the table with 50, 60, 70% of the purchase price, then have the seller hold a note for the balance. So in this example of a $200,000 restaurant, if a buyer can bring 100 or 150 to the table, but can't get the whole amount, then maybe the seller will hold a $50,000 or $75,000 note for a couple of years. And then, so those are the main, and then obviously cash. And, you don't see a lot of those, but you do see some cash deals.
Well, I'll tell you, it is hard, especially with the SBA climate, the lending climate that we're seeing for, like, if I'm looking at two businesses and one is a restaurant and another is, a manufacturing company, and I can take that same $100,000 and I can put it into a restaurant versus a manufacturing company, the risk seems easier or less than if I go to, say, manufacturing or something like that. And that's kind of where I'm heading with my next question is you have, let's just say you have two businesses, two restaurants doing the same amount of revenue, same amount of earnings, yet they sell differently. The multiple will be different depending on what, and fill in the blank. Because I think every business, every operator, every restaurant operator is sitting here going, my business is worth more than that person. And I understand that I'm out in the suburbs, they're downtown. What I'm assuming location does, but what other things, I'm forgive me, I'm answering your own my own question.
I hear where you're coming from. I mean, the short answer is they should sell for the same amount, assuming they're both either independents or franchises. Now, as we talked about earlier, for reasons, franchises work off a higher multiple. So where independents, the multiple is 2 to 2.5 times earnings. Franchises, we use 2.5 to 3 times earnings. Again, because of the security with a franchise. So taking that differential out, saying they're both independents, they theoretically should sell for the same amount. However, have they both been in business the same number of years? One may have been in business for 3 years, one in business for 30 years. The one for 30 years has a little bit more of a comfort level. The caliber of the lease. One of them, the lease is expired. You're going to have to renegotiate a new lease that hasn't been renegotiated for 10 years. The landlord's looking to get more money versus this guy has a 20-year lease with 3 options to renew. So there's comfort in the lease, right? The lease is your single biggest fixed expense. So longevity, quality of the lease, and then actually quality of the books. I've seen a lot of restaurants where the value, the cash flow or earning, well, the term is seller discretionary earnings. Discretionary earnings is cash flow on paper plus non-operating personal expenses, take out depreciation, what you're paying yourself, those types of things. If you've got a very clean P&L and the earnings is the bottom line cash flow, that's more attractive than if you have a muddy P&L and all the earnings are on my auto and what I'm paying myself. So, again, it kind of goes back to the whole valuation model, quality of the books, lease, longevity.
Well, what prompted the question is years ago when we were in this type of business, we had a portfolio of Subways, right? And there was 15 of these things, and he wanted to sell them individually. The family didn't want to keep it. And we, you could have nearly identical businesses, but in two different parts of the state, and they sold for different amounts, and like you, he's like, what the hell is wrong? I mean, it's the same business. Yeah. And anyway, that's,
the only thing I could think of there could be the buyer pool, buying pool. It's certainly the restaurant I mentioned earlier that I sold where the owner wasn't, he was the operator, not the chef. That was in a small town outside of Burlington, Vermont. So you get a lot less people looking at that listing, but usually the caliber of the buyer is better. So, it could be buying pool, but if it's two Subways with identical numbers, it's just, they should sell for some, unless there's
the moral of that story is that they ultimately did not sell individually. We found an operator that just bought them all and called it a day.
And sometimes that's the best way to go for the client as well. I will tell you that in franchises, though, even within the franchise space or even in the same space, certain brands, like anything else in life, are hotter than others. You could have a Subway, a Jimmy John's, and a Firehouse with the same numbers, and they'll sell for different prices because of the appeal of a certain.
That's good. No, that's a great example. 100%. All right. Well, so I'm bumping up on time, and my last question is one that I ask everyone before they leave is, what's the one piece of advice that you could give to the business owners, in this type of industry that would have the most immediate impact on their business or their restaurant not only from a value standpoint, but a salability standpoint?
Back to what we kind of touched on earlier is you may have a passion for food or a passion for service. Yeah. But what sells restaurants are your most recent financials. The old adage, and it may be in all walks of the industry, is people value on the finances, but they buy in the potential. So you can't tell me your restaurant should sell for more because it has a ton of potential. Because my question is, then why haven't you realized it? So if you're thinking of selling your restaurant in the next 12 to 36 months, I know that's a long stretch, but I've had clients I spoke to back in 2000 and 17 and 18 that finally come to me in 21 and 22 that want to sell their restaurant. Is get your financials in order. Not just make sure you report all the cash and try not to put a lot of personal expenses through the business. But what we talked about earlier, analyze your numbers. What is your cost of goods running? If your cost of goods is running in the low 30s, you're fine. Don't fix it if it's not broke. But if you're running in the high 30s or low 40s, figure out why. Is your pricing too low? Is your are your portions too big? Is there theft? So looking at cost, look at your numbers. Are you earning that 5 to 15%, and certainly closer to the 15 is better, to help sell your restaurant? Because then that'll help you value the restaurant. For anyone who owns a restaurant that's thinking of selling, the math is very simple. Your restaurant should value, this is kind of generic, but should value at around 1/3 of your net sales. And the way you get to that is, if you're doing $600,000 in sales, 1/3 of that is 200. If you're doing 600,000 in sales and you're making 15%, that's 90. 2 to 2.5, 90 is also 200. So it's just kind of math, but make sure that you're cash flowing properly, and that your P&L ties to your tax return. It ties to your sales tax filings, and then you've made my job much easier finding you a buyer,
right,
and also then getting you lending, because what I'm telling you to do is the same thing the lenders are going to look for.
100%.
So getting your finances in order, doing it over a period of time, even if you're biting the bullet and paying a little bit more in federal tax and things like that, if you can improve your cash flow on your restaurant by $10,000, that may cost you another $1,000 or $2,000 in taxes, but that increases the value of your restaurant by 20 to 25. It's tenfold.
Yeah, I get it. Well, my friend, so what's the best way can we get, how do we find you?
So our company is We Sell Restaurants. Our website is WeSellRestaurants.com. You Google search us, we come up to page 1, and we probably have any given time, we have close to 600 listings on our website, and
nice.
All of our contact information is there, as well as our current listings. My email address is steve@WeSellRestaurants.com. And my phone number is 770-714-4552. So any of those ways you can reach us or reach me specifically. And just one quick thing to add on, as long as I've got this. I'm just lost my train of thought. You're going to have to edit that one out.
It's no worries.
Sorry, I just lost that one.
No worries.
Okay.
So.
Oh no, I'm sorry. Can I go back and do that one again?
Yeah.
So one thing I do want to add, when most business brokers are this way, not all. When you work with myself at We Sell Restaurants, we will do a valuation for you at no cost, no obligation, and it's confidential. And when we list, it's the same thing. We list in confidence. We don't put the name of your restaurant out there so everyone knows what it is. And like most brokers, you pay us nothing until we get you to the closing table. So reaching out to us, what is my restaurant worth? How long does it take? Can you give me some advice to make it more sellable? These are things we do every day, and we do it in the hopes of building relationships.
You know what? And same, we have a 41-year-old practice. We've sold 2,200 deals, and I'm telling you that, people like us and people like you, we stay in business because of the generosity of the information we provide, and knowing you guys, because you guys we refer to you guys. I know you're a great shop. So, hey, Steve, you know what? I appreciate your time today. It's I can't overestimate or
emphasize.
I can't overemphasize just how difficult selling restaurants is. And it's a different animal. And so I am so grateful that you took the time to kind of, you really made a complex sale situation a lot simpler. So I appreciate your time, buddy.
No, we appreciate the opportunity to speak to you and your podcast attendees. And again, we're happy to help. We're very easy folks to deal with, and we're happy to help.
Well, my friend, thanks so much, and keep selling. And I'll be following up to see how 23 is shaping up for you later in the year.
So far, so good, Ed. Thanks so much for your time.
Thank you for joining us today on the How to Sell Your Business podcast. If you want more episodes packed with strategies to help sell your business for the maximum value, visit howtosellabusinesspodcast.com for tips and best practices to make your exit life-changing. Better yet, subscribe now so you never miss future episodes. This program is copyrighted by Myso Inc. All rights reserved.